Hi friends! Recent Canadian trade data shows nickel exports to the United States slipping toward historic lows. For decades, Ontario's mines quietly sent almost $4 billion worth of the metal each year to Detroit, fueling the battery supply chain behind America's electric vehicle ambitions. That flow was abruptly disrupted last August when Washington announced a 30% tariff on imported EVs, a policy aimed at China but extended to Canada, without exceptions or meaningful talks. Overnight, a well-established trade artery was hit with a wall of new costs. But before we dive in, make sure to subscribe to the channel. We bring you the most urgent global updates, exclusive conflict insights, and accurate forecasts you won't find elsewhere. Ottawa did not answer with angry speeches, but with calculated strategy. If the United States insisted on tightening the screws, Canada would make sure its nickel could find new homes. Sudbury's output had long been the backbone of US cathode production, especially for batteries using NMC 811 chemistry. At current prices, the nickel content in a single SUV battery pack runs about $775. The tariff tax on roughly $230 more, pushing the total close to $1,000 and shrinking automaker profits from comfortable double digits into the low single digits. Industry analysts warn that the added cost could wipe out close to 100,000 American EV sales in 2026. In the month that followed, Canada rolled out measures designed to shift leverage. A 15% export duty on raw nickel began squeezing US cathode makers. A carbon tracking rule ensured that Ontario's low-emission, hydro-powered nickel would move quickly through North American trade channels, while higher-emission material would face slower routes. Hundreds of millions of dollars were funneled into developing battery chemistries that use less nickel, and generous tax incentives were put in place to secure major cell plants within Canada. Government projections suggest these combined moves could divert nearly $2 billion in exports away from American buyers to customers in Europe and Asia by 2027. Signs of that shift have already appeared. In the first half of 2025, Canada's nickel sulfate exports climbed more than 20%, with South Korea and Germany increasing their purchases as the US share fell. The environmental stakes are high as well. Ontario's refined nickel carries less than 1/9 the carbon footprint of Indonesian supply and far less than Chinese material. When the European Union's carbon border tax takes effect in 2026, American-made EVs using dirtier nickel could face steep costs just to enter the market. The US is now cornered into three broad choices: carve out a Canadian exemption and keep the battery corridor alive, maintain the tariff and accept the risk of losing supply, or lower the rate enough to rebuild cooperation on critical minerals. Automakers are not waiting for the decision. General Motors has already cut its 2026 EV production target by 50,000 vehicles, wiping billions from its forecast. Prices for models like the Ford F-150 Lightning are projected to top $72,000, erasing much of the cost advantage over gasoline trucks and threatening adoption goals. While Washington debates, Canada is building bridges elsewhere. European and Korean buyers are lining up for Ontario's low-carbon supply, and the province is positioning itself as a reliable source outside the US orbit. Nickel, once seen as just another industrial input, has become a strategic asset. And in this reshaped trade landscape, Canada is showing that it doesn't need American permission to set the terms. That shift is more than a trade statistic. It's the start of a structural realignment in the way critical minerals move around the globe. Canada, by quietly opening new channels to Seoul, Hamburg, and beyond, is showing that supply chains are not fixed highways but networks that can be rerouted in a matter of months. And once a new route is established, it's rarely abandoned. European battery makers, already under pressure to decarbonize, are likely to lock in multi-year contracts with Ontario's producers. South Korean conglomerates, eager to reduce reliance on Southeast Asian laterite nickel, will be equally reluctant to give up their new, cleaner source. For the United States, the risk is not only higher costs, but a loss of strategic trust. In a sector as capital-intensive as battery manufacturing, stability is worth almost as much as the mineral itself. Every unexpected tariff or policy shift sends a message to investors. The rules can change overnight. When billions are on the line and supply chains span continents, that uncertainty is enough to redirect entire projects to friendlier jurisdictions. Already, whispers from industry analysts suggest that future gigafactory investments, the very facilities Washington hoped to attract, may instead break ground in Ontario or even Northern Europe, where access to clean nickel is more secure. Environmental politics will only deepen the divide. The EU's incoming carbon border tax is just the first in a wave of policy tools designed to punish high-emission imports. As more countries adopt similar frameworks, the competitive advantage of low-carbon minerals will grow. Ontario, with its hydro-powered refining, will remain at the front of the line. US producers forced to source from Indonesia or the Philippines will face both reputational and financial penalties, adding another layer of cost to every vehicle they try to sell abroad. Canada's position is strengthened by the fact that nickel is just one piece of the puzzle. Cobalt from northern Quebec, lithium from Manitoba, and rare earth elements from the Northwest Territories all sit in the same strategic portfolio. Ottawa has made it clear that these resources will be leveraged together. If the US wants one, it may have to come to the table for all. That bundling gives Canada a kind of negotiating power that tariffs can't easily undermine. Meanwhile, Washington's current course risks creating a two-tiered EV market at home. Luxury electric models for the wealthy and cheaper gasoline vehicles for everyone else. Such a divide could slow the transition to cleaner transport by years, undermining climate goals while giving competitors abroad a head start in technology, scale, and market share. The irony is sharp. A policy meant to protect domestic industry could, in the long run, weaken it by isolating it from the very supply chains it needs to thrive. If the tariff remains in place, the next few years could see a decisive split. North America's battery production might fragment, with Canada's capacity integrated into European and Asian networks, while US manufacturers find themselves increasingly dependent on lower quality, higher carbon imports. In such a scenario, the battery belt, so often touted in US political speeches, would be less a continental supply chain than a patchwork, vulnerable to both market shocks and diplomatic friction. In the end, the question isn't whether Canada will find buyers. It already has. The question is whether the United States will recognize that in a world defined by resource competition and climate commitments, your closest neighbor is more valuable as a partner than as a target. For now, the trains, trucks, and ships that once moved Sudbury nickel south are learning new routes. And once they settle into those patterns, it may take more than a tariff rollback to bring them back. The more this standoff stretches on, the clearer it becomes that we're not watching a minor trade disagreement, but the early stages of a realignment in global mineral politics. Nickel is the headline, but the subtext is control. Control over who supplies the clean energy transition, and on what terms. Canada, by holding its ground, is signaling that it's willing to choose its partners based on stability and reciprocity, not proximity. In an era when every ton of clean nickel is already spoken for years in advance, that's not a threat. It's a market reality. Other nations are taking note. European trade officials who have spent the last decade trying to wean themselves off volatile sources of energy and raw materials see Ontario's deposits as a chance to lock in secure low-carbon inputs for their battery industries. South Korea, always quick to adapt its supply chain strategy, is moving with similar speed. These countries understand that long-term contracts today could shape their competitive position in electric vehicles for the next 20 years. And every shipment Canada diverts eastward is one less that can be redirected back to the US, even if the political winds shift. For Washington, the longer-term risk is that this pattern repeats across other critical minerals. Lithium from Argentina, graphite from Mozambique, cobalt from the DRC. All of these markets are being quietly tied up by competitors through forward contracts and strategic partnerships. If the US becomes known as a buyer that adds tariffs without warning, producers will simply sell to markets that offer predictable terms. The resource nationalism of the 20th century was about controlling oil wells and pipelines. The resource competition of the 21st is about securing battery metals before someone else does. There's also a technological dimension to this shift. The more Ottawa invests in LFP chemistry and other nickel-light battery designs, the less dependent it becomes on Sudbury's own output for domestic production. That creates room for Canada to export a higher percentage of its best material abroad, while keeping its own EV industry insulated from global price swings. Meanwhile, US manufacturers locked into high nickel chemistries could find themselves squeezed between rising input costs and competitive pressure from cheaper foreign EVs. Even the climate math favors Canada's position. Global investors, especially in Europe and East Asia, are increasingly screening supply chains for carbon intensity. Ontario's hydro-powered nickel refining is a rare asset in that regard, while laterite nickel smelted with coal power is becoming a reputational liability. As green regulations tighten, clean minerals will command a premium, and that premium will go to suppliers who resisted short-term political pressure and focused on building trust with long-term buyers. It's not difficult to imagine the trade maps of 2030 showing Canada as a central hub in a clean mineral corridor stretching from North America's Arctic to Europe's industrial heartlands and Asia's tech capitals. A network where the US appears as a secondary customer rather than the primary destination. If that happens, it won't just be about nickel. It will mark a deeper strategic shift in which Canada leverages its resource base to gain more influence over trade policy, investment flows, and even climate negotiations. And that's the irony. By trying to play hardball over one mineral, Washington may have handed Ottawa the opening to reposition itself as a global gatekeeper for several. The question now is not whether the US can reverse the current drift, it's whether the rest of the world will even want it to. If you want to stay ahead of the curve with real-time updates, in-depth analysis, and expert insights on global flashpoints like this one, make sure to subscribe. This is just the beginning.